get your exams back, and I have been grading them, but I'm not finished yet. So I'll be returning them to you in class on Thursday, and we'll also go over the solution on Thursday. Well, I've only graded I think the first 3 problems. It was a mixed bag. Some people did great, some people made a few mistakes. So, for the announcements, remember that you've now got 2 days remaining to finish the project. That should be uploaded to Blackboard before 4 p.m. And then following that, the next homework assignment is due on Tuesday of next week, so you've got a week to finish that. Today we're going to be talking about bonds. And before we begin, are there any questions on the announcements? All right. Bonds is a topic I've found in the past that students really struggle with, so I'm hoping that this makes sense today. It's maybe not the hardest thing we're going to do this semester, but what I would say is it perplexes me that students find it so difficult because it's actually pretty simple, but I think maybe people just tune it out. So hopefully you won't tune it out today and it'll make sense. A bond is an interest-bearing certificate, and what it is an agreement between a bond purchaser and a bond issuer, which may be a government, it may be a company, it could in theory be an individual, where what you're doing is when you're buying a bond, you're giving someone money in exchange for a legally enforceable contract that you're going to receive periodic payments over time, interest payments, and then some lump sum in the future. And there's a wide range of variety in bonds, depending on who the issuer is. Let's look at a couple of bonds that are available on the market right now. I was looking at these details just before class. Should take a moment to load. All right, I'll zoom in to make that a bit easier to see. You can see across the top, there's a lot of different countries that are listed here. And how do I make that go away? There's also corporate bonds, but let's just look at some of the different parameters that are here. You can see the duration of the bond, as well as what's being called here the yield. But what's not listed here is the price of the bond, and it's also not listing the face value rate of return. It's only listing the yield. And we'll talk about why that is and what are the different pieces of it. But what you'll notice is that generally speaking, you'd expect to be a longer term, like for a longer bond, a higher rate of return, but actually that's the opposite on this. If you look, a 1-year bond is yielding 5%, whereas a 30-year bond here is only yielding about 4% right now. So what that's called is an inverted yield curve, and a lot of people take it as an indicator that the economy is in turmoil if there's a inverted yield curve where the long term seems more secure to people than the short term, is what that means. When the longer range bond, where you're locking in your returns for a longer period, has a lower interest rate than the short term. So the U.S. has bond rates. Here you can see the U.K., Germany's bond rates are even lower than the bond rates in the U.S. And so just in the same way that we've talked about loans before, where there's a default risk that banks take into account when they are issuing a loan to someone, there's also default risk in bonds. So the German government, just to use a specific example, is thought to be relatively low risk because they have a stable economy. Their government doesn't do as much deficit spending as a lot of other countries. You know, they only spend the money that they have coming in as tax revenue. Well, I guess that wouldn't be exactly true, otherwise they wouldn't be borrowing money through bonds. But the ratio of their income to their spending is more favorable than some other countries. They have more fiscal controls, and so the German bonds have a relatively low yield because they're seen as a stable investment that don't demand the same kind of default risk premium. But if we compare it to Brazil, as another example, look at the interest rate on the Brazilian bonds, where a one-year bond has a yield of 13%. And so the market is anticipating that there could be currency risks because these Brazilian bonds, I don't know if these particular bonds are denominated in dollars or if they're denominated in whatever the currency is in Brazil. I'm not sure. But it could be a reflection of currency risk where they're thinking that the currency could be devalued. It could be a reflection of the fact that the Brazilian government is doing more deficit spending, and so they see more of a default risk issue. So that's just an illustration of a couple of parameters that have to be considered when you're calculating what is the value of a certain bond. And here's some other bond rates where it is including the price, the coupon, and the yield. So what we saw just moments ago was only this middle column, the yield, which is talking about the interest rate that's actually being earned if you buy the bond at the price that it's trading at in a given moment. Originally, each of these bonds sold for $100, but that was the day that it sold, was at $100. Since then, the prospects of the company may have improved so that it's seeming like a much safer company. And that would be here the case of, for example, Wells Fargo. When it sold its bond, it sold the bond for $100, but now that bond is seen as more valuable. And so it's trading on the secondary market for $113. So when they originally issued the bond, Wells Fargo said that they'd pay a coupon rate of 4.75%. So when they pay out periodic interest, they're paying out 4.75% of $100. That's how much Wells Fargo is paying each year as interest. But the secondary market is saying, well, Wells Fargo is a more stable company now, so they're willing to pay more than $100, the original issue price for that bond. And what it does is it brings the yield down. Although Wells Fargo is paying 4.75%, if you paid $113 for that bond instead of $100, what it does is it brings down the effective interest rate that you're making on the investment from 4.75% to 1.77%. So here, the Merrill Lynch bond is still at its face value of $100. So the face value and the current price is the same, which is why the coupon and the yield are the same. And so what you should notice is that anytime the price is higher than its original purchase price, then what that does is it depresses the yield. But anytime that the purchase price is lower than the original face value, so look at this Chesapeake Energy. That's actually a firm of some regional significance here. They have, I think, gas holdings throughout Appalachia and Ohio. So Chesapeake Energy makes natural gas, and at the time that I got these prices, their bonds were trading for $61.15, and those originally had cost $100. And so what that means is that even though Chesapeake is only paying 5.75%, they're paying 5.75% on $100. But if you buy the bond for less than $100, that increases your yield quite a lot because you're earning the interest on the original face value. And then also, at the end of the loan period, Chesapeake will return $100. So there will be a lump sum payment at the end as well. So all of those factors take into account, it brings the yield up, in this case, above 30%. So that should be the trend that we see in the pricing data, that when the current market value is above the initial face value, then that suppresses the yield below the coupon. And then when the purchase price is below the original face value of the bond, then that raises the yield above the coupon. Any questions so far? Okay, so let me show you the formula. This seems complicated, like the talk of coupon and yield and so on. It seems complicated until you see the formula is really just the same factor ideas that we've used before. Let me go back to taking the Chesapeake Energy case. what you do if you buy the bond is you're paying some money now, so the value now is what you're paying for the bond at time 0, and then you're going to get these interest payments over time from the bond, and then on the last purchase, the last interest payment, you also get a lump sum. So there's a lump sum, and so this is like an F, the lump sum. This is the interest payments, and this is an A, an annual series. And oftentimes the question is, how much should you pay for the bond? You know, like if someone is promising you a certain string of interest payments, and they're promising you a lump sum at the end, and you're trying to achieve a given yield, so it would be saying for I, meaning the yield you desire, for a given yield that you want to achieve, how much should you pay for the bond? That's kind of the classic problem that we're going to be solving today. And so the formula for that is just that you take the C, which is the redemption price. So redemption is a lump sum out in the future. So this future value that we're trying to take to the present is the redemption price. C. And then you'll notice what's inside the parentheses here is find P given F at a certain interest rate I and for n periods. Now, one of the things that makes bonds, I guess, a little bit tricky is that sometimes they pay out more often than annually. Probably the most typical thing is that bonds pay on a quarterly basis. So quarterly means every 3 months. So if it's paying out quarterly, that means that there's 4 payments per year. So for example, if the bond lasts 30 years and there's quarterly payments, then that would mean n equals 120. So you just have to think that n isn't always the same thing as the number of years. But here, we just find out how many periods are there, and then I is the interest rate per period, which is associated with the yield that you want to achieve. So there's 2 different rates. Remember what we saw before. There's a percentage that's about the coupon, and there's a percentage about the yield. So coupon is how much the company is actually paying, and it's based on the face value. So, for example, if you are told that the coupon is 4.75%, that means 4.75% of the original face value, that's the annual interest that's paid. And so then on a quarterly basis, you'd have to divide that by 4 to find out the interest payments per quarter. So this is going to be the present value of that lump sum in the future. Now R times Z is the interest payments themselves. And so each one of these is R times Z, where R is the coupon rate and Z is the face value. So by face value, that means the purchase price of the bond, or in the contract, it says how much you're paying for the bond. And so the company agrees to, like, how much interest they're going to pay you is based on the percentage rate that they quote and the face value of the bond. So sometimes you might be given R times Z directly. Sometimes in a problem they might say that your periodic interest is $50 every 6 months, something like that. So if they said you're getting $50 every 6 months, then that is R times Z. Sometimes they'll give you the face value and the bond rate, and you'll have to calculate what is the amount of the annual interest. But what you can see is that we're finding P given A, so that's finding the present value of some periodic quantity over time at the yield rate for n periods. So we've done these things before, where we're finding a single future value, present equivalent, finding an annual value, present equivalent. You combine the two pieces together, and that tells you how much you should be willing to pay for the bond today. So that's how you calculate V sub n. So any questions about terminology? As you probably expect, it just gets easier to solve these the more practice you get. So what I've created is 3 problems that we're going to work through together today, just so you can get some practice interpreting the language, get some practice seeing how the numbers fit into the equations and so on. So one of the problems, I've got a factor table provided for you. Another problem, problem 2, we're going to use the equation method, and I'll put the equations on the whiteboard. And then the third problem, we're going to work together using Excel. Well, for the second half of that third problem, we'll use Excel. So there will be a point at which it'll be useful to get your calculator going. But for now, let's just look at the first problem, where we're going to try and find the overall value now by accounting for the present value of the redemption price and the present value of the interest payments. So let me give you the handout here. This is the problem on the screen too. To try and guide you towards the correct substitutions, I'm asking you to fill in the blanks. So interpret the problem statement and fill in the blanks.
Semi-annual is.
Let me just interrupt for 1 second and ask you a question. Why do you suppose it's in bold here that I said per period? Yeah, because it's not the same as the number of years. So it's 10 years, but the number of periods is 20 because it's semi-annual. So because its n is 20, that changes I and R. So it changes the rate and it changes the yield, because we want to know the interest rate in terms of per period for both of those. You can see on the whiteboard that I've written n equals 20, R equals 0.03, I equals 0.04, C is 1,000, and Z is 1,000. But I've only given you the 4% table. That's the only thing that you need, is the 4% table. You don't need an interest rate table for 0.03, because the 0.03 is only used to calculate the value of the interest payments. And so R times Z is outside of the parentheses. Inside the parentheses is the interest rate that you're going to use the factor table for. Do you have a question?
Yes. Are you going to give us like 2 values for the face value separately, or redeemable, or these both are just the same?
Sometimes they're different, and in our third example today, they're different. Oftentimes they're the same, but not always.
Okay.
Yeah. Jace?
Why is R 0.03 not 0.003?
Because it's 6% per year, and so 6%, if 6% is 0.06, because it's basic, you divide that by 2, 0.03.
Yeah, does
Yeah, face value is kind of like, there's a piece of paper, the bond is a piece of paper that's an agreement between two people, and the face value is what the piece of paper says is the selling price for the bond. And
That's at that specific time.
when the bond is originated, like so when the contract is very first issued, the price that it's sold for is the face value.
So the face value for all those other ones was $100?
Yeah, right.
Okay.
Yep. So here, this one, you can see that it's just a matter of substituting into the formula. So I is related to the yield, R is related to the rate. I guess we could call that like the face rate, because it's the rate that the bond issuer is paying interest for. And so
So that will never change, but the yield will change?
exactly. Yeah. The bond issuer only ever has to pay what they agreed to at the beginning. They have to pay, in this case, $30 twice per year. And so the overall value of the bond is the discounted value of the interest payments and the discounted value of that lump sum in the future, the redemption. Do you have a question?
Yeah, so I guess I'm just having a hard time understanding, like, if its face value is $1,000, that's how much the piece of paper is worth.
Mm-hmm.
And the redemption price is also $1,000.
In this case.
In this case, I
Yeah.
guess that's not all the cases, because you said probably three, we'd have different prices.
Yeah.
What is the benefit of buying it if its value is the same as its redemption?
Yeah,
It's
because-
the interest. It's that, like you're paying 1,000 and you're going to get 1,000 back in the future, but between now and then you're also getting interest payments.
Oh, okay, the interest payments are separate.
Yeah.
Okay,
So-
so it's like guaranteed, it's guaranteed money.
Well, it's guaranteed as far as you believe the issuer has good credit. Like if who's a really, let's look up corporate bonds to see who's the shadiest.
Is the redemption price ever lower than the face value? Like, say you had like an astronomically high interest
Sure,
rate.
it could be, but then you'd have to have big interest rate payments.
Okay,
Yeah.
okay. I understand.
Yep.
Thank you.
Sure. See if we can find some example corporate bonds.
Isn't there a bond right now that's like you can only buy $10,000 of it, that's like 11% or something?
Yeah, those are I bonds. Those are government issued, and it's a great deal, but you can only, as you point out, these are not
Can
corporate
you
bonds.
could buy individual ones though, couldn't you?
Buy individual bonds, yeah, but they're not at that high interest rate. Like you can buy as many non-I bonds as you want.
And you only buy one I bond though?
Well, you can only buy $10,000 per year, so you could buy it in multiple purchases, but cumulatively across the these are all indices. I want individual companies, but let's just say, for example, Captain D's, right? Has anybody here eaten at Captain D's recently?
Never heard of it.
It's a fish restaurant.
Yeah.
Yeah. I mean, it's okay, but the parking lot isn't crowded in the same way that Chick-fil-A. Like when I drive by Chick-fil-A, there's a long line. So if Chick-fil-A was selling bonds, I think probably their rates, like the rate that they have to agree to get buyers, like they could both sell bonds for $100. But probably like if Chick-fil-A said, hey, we've got these $100 bonds, people would say, okay, well, I'll buy it and 3% is good enough for me. But if Captain D's was selling bonds, people might say, 15% sounds good, for the same face value. But then like if all of a sudden people went crazy for Captain D's new fish sandwich and like suddenly they looked like a much stronger company, then probably what would happen would be the secondary market would start charging more for their bonds than the original face value of $100. And so then that would push the yield down. Yeah. So in this case, the value of the bond is $864.11. And that is if you're trying to achieve a yield of 4% per period, which is 8% nominal year, 8% nominal yield per year.
I got a question too.
Mm-hmm.
So, for the initial bond price, say it's like $1,000, like number one, and
Yeah.
say in this example, 10 years later, you're gonna get a lump sum of $1,000.
Yeah.
Technically, that $1,000 you're gonna get in 10 years later is not gonna be really worth the same thousand, so it's.
Yeah. And in fact, like the present value of it, we can see right here, that's $456.40. If we discount that 1,000 to time now at the 4% that we're trying to achieve, our 4% yield, you're right, it's not worth as much. You know, 1,000 now is, 1,000 in the future is only worth 456 now. So it's a huge discount. And, you know, 4% is pretty mild by today's standards. You know, like interest rates are much higher now than they have been in the past. I wish I could find some good corporate bond
So you
prices.
get 4% on $1,000 every 6 months.
Well,
No, you get 3%.
3%. Yeah.
You get 3%.
You get 3%, but you'd get, like, if you paid $864 for it, you'd be getting 3% of 1,000, even though you only paid, like, on the secondary market. If you found someone who's willing to pay to like take $864 for their bond, because maybe,
Coming out ahead.
yeah, you'd be coming out ahead. Yeah, because like when you buy a bond that has a 10-year life, you don't necessarily have to keep it the whole 10 years. You could sell it to someone else. And if you sell it to someone else, though, you're going to be at the mercy of whatever the market thinks about the value of that bond. And so it's related in part to just the environment, the interest rate environment, and it's also related to the health of the company or government that issued the bond.
Are they as easy to sell as like stock?
Yeah,
Like how you can just get on your phone
Yep.
and sell it?
yeah.
Knowing
Yeah.
as much as you know, do you have you bought bonds before, or do you do stock market, or?
The only bonds that I own are, like directly, are those I bonds, the ones that have a high interest rate. Like, let me show you.
Not to get personal. Or
No, it's fine.
I've always wondered that. For
Yeah,
like,
so
people
I-
that use this stuff, do they-
I buy I bonds, which are these ones that are, looks like right now paying 6.89% for the I bonds. That changes every 6 months. So I buy I bonds, but you asked about like individual stocks. I do own some individual stocks, but I wish I didn't. I wish I just had
Me too.
index funds. I would have been better off if from the very beginning of my investment I just only had index funds, because every time I've tried to outsmart the market, I've lost. I'm not successful. I don't know as much as the collective intelligence of all the brokers on Wall Street.
Gotcha.
Yeah. Yeah. All right, so that's the first problem. Any other questions on the mechanics of how we solve for this value? Okay, so let's get some additional practice with this next one. Okay, so problem 2 says you wish to invest in bonds that have a face value of 100. So that means like the person who bought the bonds in the beginning paid $100. That's what the interest rate is going to be paid on. So this bond rate of 6.50% per year, and it says the bond interest payments are paid twice per year. So same as the last one, we've got semi-annual bond payments. In 25 years, the bonds are redeemable for $200. Okay, so we've got one where the redemption price is different from the face value. If you're willing to accept a yield rate of 5% per year, how much should you be willing to pay to purchase the bond? Okay, so
Nominal means that we don't have to divide the interest rate, right?
no, I'm glad you asked that. Nominal means all you have to do is divide by the number of periods per year. Remember, the difference between effective and nominal is you take the compounding into account. So like 5% per year compounded twice per year would be like 5.1% effective. So here, this is just all you have to do to find R and I is divide the percentage that's given by 2, and that'll give you the interest rate per period. So this is very similar to the first problem, except that, let's see, except that now we have a different redemption price than the initial purchase price face value. Okay, so repeating many of the lessons from before. Now, you don't have a factor table though for this one, so let me give you the 2 formulas that you're going to need to solve it. I'll write them on the whiteboard. Okay, so the P divided by F is 1 plus I to the negative n. That probably rings a bell. And then P divided by A is 1 plus I to the n minus 1 divided by I 1 plus I to the n. Okay, so my advice is start your work same as the last problem where we begin with the formula. So we begin with this equation, V sub n is C P slash F I percent n plus R times Z P slash A I percent n. Okay, so what you need to do is calculate how much is the interest, what is the redemption price, and we're finding out what's the present value. So this VN, that means value now. So what is the PV, the present value of the lump sum that you're getting in the future combined with the present value of those periodic interest payments? Okay, so for problem 2, once again, we have to calculate the interest rate per period for the yield and for the bond rate. So here we're dividing by 2. If it had been quarterly, we divide by 4. If it's monthly, we divide by 12. We just find out the rate per period. And so what we're doing is we're finding out the discounted value of the lump sum redemption price, and so $200 in the future is only worth $58 now, and then the sum of all of those interest payments over time is present value of $92.18. So we should be willing to pay $150.37. Let me ask you this. What if the price was actually $140? So then what does that mean about the yield? If the price was $140, what's the yield?
I guess if the base value was 140?
No. If the secondary market was charging $140 for so the face value is still $100, but what if you went to try and buy this bond from someone and they are willing to sell it to you for $140? So then how does that affect the yield? It would be higher than the 5% that we've calculated here. But what if they want $160? Then that tells us, well, you're going to be getting less than the 5% yield that we've counted on. So, depending on how much less, maybe you're okay with less than 5% yield. And so as the value of as the bond price goes up on the secondary market, the yield goes down. They work in opposite directions. Okay, so we've done one of these using factors. We've done one of these using the equation method. Are there any questions on the second one? All right, so the third problem, let's define the variables here. Let's try and identify what we know. And then we're going to use Excel to take this the rest of the way, because so far all we've been solving for is V sub n. But in this problem, V sub n is given. So we're solving for something different, which makes it a little bit unfamiliar. Okay, so it says a certain bond will pay $55 4 times per year for 10 years. Okay, so that sounds like a description of the annual payments. So you know that annual series. So the R times Z is $55. So that is the periodic interest payments. Okay, R times Z is 55. It didn't tell us what the the bond's interest rate is. It just tells us directly how much that interest amount is going to be. All right, followed by a lump sum payment of $1,000 10 years from today. So C, which is the redemption price, is $1,000. And it says if the bond price is 900, so that's saying V sub n, the value now, is 900. And it already said that it was a 10-year period, and it's 4 times per year. So that tells us n is 4 times 10, so that's 40 periods. We want to find out what's the yield of the bond. So if we were going to express this in terms of the formula, so if we're going to express this in terms of this formula,
Do we need individual R's and Z's, or is it okay to have them as one parameter?
it's okay to have it as one parameter. Sometimes you're given that directly. We could calculate what is R. We have enough information to calculate what is R because we know the face value. Well, actually, it doesn't say specifically what is the face value. It tells you the redemption price is 1,000, but we don't know the face value of the bond, but we don't have to know it because we know R times Z. Okay, so if we're going to substitute in the values that we know, it's $900 is equal to 1,000, which is going to be discounted by the find P given F at some interest rate that's unknown, and N equals 40, plus 55, discounted using P/A at interest rate unknown for N equals 40. So what we're going to do is we're going to use Excel to try and change like a bunch of different I values that finally makes this equation equal. We're going to use Excel as our equation solver. And we're going to use the built-in functions in Excel, because what function do we use for find P given F? Well, that is the PV function. What about find P given A? That's also the PV function, but when we use it, in this first PV function, we're going to be putting in a lump sum amount, that's the FB, and then this 55 is going to go into the PMT field, which oftentimes we skip over, but we won't in this case. So if you've got Excel, start up a new spreadsheet, and let's put in here some values. So R times Z is 55. N is 40. C is 1,000, and V sub n is 900. So in other words, current market price of the bond, this is the redemption value. Oh, I just keep this is the number of periods, and this is the all right. So what we want to do is we want to have some guess value of maybe what is I. So this is going to be yield per period. So I don't know, is it 1%? Maybe. We'll find out. I got to format this as general, not as dollars. So I'm going to start off with a guess of 1%. And so if it is 1%, then calculated bond value so basically what I'm going to do is I'm going to say I'm going to play around with the interest rates until I find that the right-hand side of the equation equals $900. Okay, so the right-hand side of the equation, I'm going to just say RHS. The right-hand side of this equation, so the right-hand side of the equation equals C, okay, so C times, and now maybe a better way to do it would be PV of this rate that we are solving, trying to use the yield rate. Okay, so this interest rate, NPER, is 40 periods, and then the amount we're going to put in the payment is minus of R times Z. Okay, so that part of it is just going to be the sum of the present value of the interest, okay, plus PV of same interest rate, same N. Now this time, the amount we're putting in is a payment. Hold on a second. Payment, If I'm doing the C value first, I should do the redemption. So if I set it up so it's the lump sum redemption followed by the interest rates, let me, just to avoid confusion, start over, because I want to maintain the parallelism with the way that this formula is set up. I apologize. So equals PV of the interest rate, N is 40, and so what we're going to try and do is the C, the redemption, is $1,000, so that is a lump sum. So I don't want it to be in the payment field. I'm going to skip over the payment field, and it's minus of 1,000. Okay, so if I just do that real quick, that's saying that at 1% discounting, $1,000, 40 periods in the future is worth $671 right now. Okay, so that is, this first part so far that we've got in the formula is the lump sum. Now I'm going to continue by adding on the PV of the annual amounts, so the periodic interest payments. So again, use the yield and the N, and then minus of the interest payments. Hopefully it'll let me put two functions together at the same time, two different PVs. It did. All right, so it's saying that if you're willing to accept a yield of just 1% per period, then the value of that bond, you should be willing to pay $2,477. We're not. We want that right-hand side to equal 900. So we're going to keep changing this I until this right-hand side that's been calculated is equal to what we know it should be equal to, which is 900. So 0.03. We're getting closer. 0.04. 0.05. Maybe we should do goal seek, right? Data, what if analysis, goal seek, and so this is, we want this to be a value of 900 by changing the interest rate. Okay. So the yield is 6.17% per period, and therefore the annual yield would be 4 times that, because there's 4 periods per year. So this is the yield per period. I guess I could start another row and I could calculate the nominal yield per year would just be this times 4. Okay, so let me just one more time explain the methodology here. I'll delete this. So we don't know exactly what is the yield that makes this bond equal to 900. We just know that's what people, they want, they're trying to ask $900 for the bond. So, you know, like in these, the table that we were looking at before that was this, the yield was calculated for you. What if you had to calculate the yield, given the coupon and the price? Well, you could do it using this approach. So we just know that on this right-hand side of the equation, it should be the present value of, using this yield per period, 40 periods, and I'm going to skip over the payment field for this first one because this is the lump sum redemption. So that goes here in the FV area. So the lump sum redemption is the 1,000. And then we're going to also combine, now the second part of this is the present value of, again, at the yield per period, and for 40 periods, the recurring interest payment. And when we play around and find that perfect interest rate that makes the value equal 900, which is what we know is the asking price for it, then what we've done is we've calculated the yield per period. So, like if in words, what I would say is, thus, if the market price of the bond is $900, then the yield of the bond is 6.18% per period, or 24.72% nominal per year. Yeah.
So is this, by calculating that yield, is that how much it would be for someone buying a bond to not benefit or lose any money by purchasing that bond?
What it means is, if you bought this bond for 900, it's like your return on investment is 24% per year.
Okay.
That's your interest rate that you're getting,
Okay.
which would be way better than the bank,
Yeah.
assuming that this company actually pays its interest. Sometimes the yields will skyrocket because,
They need it at a certain time?
well, if you're worried that a company isn't actually going to be able to pay its interest payments, then the price of the bond goes down, you know, like 900, 800, 700. And so sometimes the price of a bond going down is like people voting like a lack of confidence. They're saying, I don't think that these guys are going to be able to make their $55 periodic interest payments. And so like high yields looks good, but you got to keep in mind that there's default risk there. And so the reason why this has such a high interest rate is because it may be that they don't pay you 40 periods of $55. They're supposed to, but if they go bankrupt, then they can't. Bondholders have more collateral than stock shareholders. You know, like when a company does liquidate and becomes bankrupt, people who own bonds generally don't suffer as much as shareholders do. But, I mean, you don't get all of your money back necessarily. One more thing I wanted to ask you about is I've been using this word nominal today. Do you remember the difference between nominal and effective? I think we've got a formula that relates that. Let me see if I can go back in the notes and find effective. Here we go. Here's the formula for nominal versus effective. So let's use this formula and calculate if it's 24.72% nominal per year, what's the effective rate per year? Okay, so to use this formula, R and M mean different things than it did before. So like just from this, the R that we've calculated in this equation is going to be 0.2472. M is 4 periods per year. So the effective interest is going to be 1 plus R divided by M to the power of 4 minus 1. So 24.72% per year nominal. So this is the nominal interest rate. When it's compounded 4 times per year, this is the effective interest rate. It takes into account the effect of compounding interest. But the reason why nominal interest rates are often used in the cases of bonds is because for it to truly be effective, you have to reinvest the interest back into the original investment. And that's not likely to be the case for this bond. You know, when this bondholder gives you $55, you can't take that $55 and put it back into the bond because maybe they're not selling that bond anymore. And if they are, it certainly isn't at the yield that you bought it for. So that's kind of why nominal interest rates are discussed in the context of bonds, is that to achieve some effective interest rate, you have to reinvest the interest that you get. And interest here is paid out, unlike a savings account where the interest just goes into the same account and truly does compound.
Can you repeat it? How did you get it?
I just used this formula. So what I used was 1 plus R divided by M to the power of M minus 1.
I thought you used some function or something.
No, I just typed it in manually.
So the higher the yield rate, the better.
Yeah, I mean high yields are good except for that they indicate danger. You know, like you could buy bonds from the Greek government a couple of years ago that had a yield of like 30%. And you know, 30% interest is fantastic as long as they're actually paying it. So,
But the yield rate only affects what you pay for the bond, right?
it's reflected. The yield rate is a reflection of what you paid for the bond. And the only reason why the price of the bond would go down is if the value of the bond is lower. And the value of the bond goes down as long as people start questioning whether or not the entity is going to continue to pay their interest or pay off the lump sum in the end. So like bond prices don't go down for no reason. They go down either because interest rates in the environment have gone up or because the company is at risk. complicated, but
Does the public determine, you kind of been saying, like the market determines?
that just means like the collective intelligence of everyone who's buying and selling bonds. So there isn't like a central agency that decides what the price should be at any given time. It's just dictated strictly by supply and demand. So like when the Greek government had these bonds that yield 30%, it's because there were very few people who were willing to buy them. That's why the prices went so low. So what made the yield high, like the Greek government on those bonds that they had already issued, they didn't have to pay any more interest. They were paying the same interest that they always paid. It's just that to buy the bond from someone else, you were paying less than they bought it for. Like they wanted to sell it to you because they were worried that, you know, like maybe the bond was just going to be contract void and that they were going to lose everything.
The yield rate and the coupon rate are interchangeable, right? They're the same thing?
No.
No?
Coupon is what the borrower is actually paying. So R is the coupon rate, I is the yield rate. Coupon means, like, think about the certificate. If we had a bond certificate, like if it's a contract bond, okay, what it's going to have on it is maybe like 5% per year. And it'll be like, it would say 10 years, quarterly, and then like $50. So like a bond would have those three parameters. It would have an interest rate, a duration, compounding frequency, well, not compounding frequency, but how frequently the interest is paid out, and then the purchase price. So this is face value. This is the coupon rate.
That's what they're paying you.
Yep.
Yeah.
And then the
$50.
10 years quarterly. So there is something called a zero coupon bond. And you've heard of Warren Buffett before. He's really a fan of zero coupon bonds because what it does is it reduces your tax liability. You know, because you have to pay tax. Anytime you get money coming to you, you have to pay tax. So what he likes is he likes bonds where it's just a single lump sum in the future. He doesn't want to get the interest payments periodically because then he'd have to pay tax on those. But if it's just a big lump sum in the future, you don't have to pay the taxes until the future. So you're kind of like deferring your taxation. So, you know, there can be bonds that don't pay any interest and it's just a single lump sum in the future. So that's like a zero coupon bond if you ever hear about that. And there also could be a bond that had no redemption value. It could just only be interest payments. It could be either extreme. Okay, well, we have done it. We've talked about bonds. Just a reminder, because we've got a couple of important deadlines coming up. Let's just revisit. Oh, we've really made a lot of progress if we're all the way down here in the file. We've covered a lot. There it is. Thursday, project. And then Tuesday of next week, homework 5. Homework 5 does not include any bond problems, does it? Has anybody looked at that? I don't think it has.
It's posted online, is it?
Yeah.
Is it not?
I will check. Let me double check.
Mm.
Assignments. I don't see it on there.
Okay.
Was it assigned today?
Right before the test, all assignments were gone.
Okay. Yeah, maybe I just haven't loaded into visible mode yet. So, yeah, I don't think that, I guess I knew that you wouldn't start on it before the exam. So, so it will be due a week from today. It will include some bond problems as well as, I think there are a couple of topics like this unrecovered investment balance that are going to be included on that as well. All right, well, I'll see you on Thursday. Good luck on the project, and if you have any questions on it, feel free to